Hello, and thank you so much for joining me for this tutorial. I'm going to quickly just walk you through like this model that I created quickly. What I did is when I was planning to record this video, I went on the real estate market here in British Columbia, Canada, and I saw a house in Abbotsford that goes for like 600,000 on the market. Like I can show you here, but what I found interesting was like I just wanted to get some data, right? And I now want to compare these two situations. For example, one is investing in a house that is home ownership, and then the other person, let's say, on the same income, investing in the stock market, and want to see how much will each of these make in the next 5 years. Of course, this could be different, but the situation here in Canada is that usually people get a 5 year term mortgage with an amortization for, let's say, 25 years, but they renew it every 5 years. But now, in this case, I'm assuming that, let's say, this person puts 20% down payment, which is 20% of 600,000. That is 120,000. This other person who is investing in the stock market is investing in the S&P 500, which has historically retained about 10% per year. But then the rent, roughly in Abbotsford, Surrey area, is like 2,300 per month. And then if I look at the mortgage payment, let's say if this person wants to go for this house, would be 3,000, about $3,367 per month. So what then happens is every month this person is paying mortgage and this person is paying for the rent. But then the difference between the rent and the mortgage is then what this person would be investing in the stock market for the next 60 months, that is the next 5 years. And then I compounded it for the next 5 years at a rate of 10% per year. But then for the capital appreciation, I looked at the data. It is about 8.8% the return in Canada for the real estate. I took the national average. But it is important to say if it's a deeper analysis, this is just a static model. And these assumptions can change, and then this also can result in the change in the results as well. Because, for example, if a person holds the real estate for longer, right, the principal might also, be falling, right? You can see right here, for example, that this principle is falling over time. But I just took, like 5 years at this point, right? And obviously that's a model that I can do, let's say for clients, they come to me, they want me to run the numbers and look at the different scenarios. In this case, it's fixed interest. I'm just taking this estimate from this particular financier. And the results in this case show that home ownership, in this case, this person would get the capital appreciation of 181,351 in 5 years at this under these conditions. But of course, the nuances. There's a federal program here in Canada to say if you're buying your first home, the government can contribute something, and some people can go into a house home ownership for 5%, but those are nuances. But for this particular case, I'm assuming 20% down payment. That means insurance premium will be lower, all things equal. But then at the end of those 5 years, this person would have paid out 138,000, and I'm assuming that the rent would be fixed just for simplicity in this case for the next 5 years. And this person would have, paid out these amounts in terms of the expenses. And at the end of these 5 years, the difference would be 93,657 in favor of someone who has a position in the stock market, like holding stocks. So I just wanted to illustrate this, and that at the end of the day, it all depends on the nuances. Some people, they just want a house, but sometimes these assumptions might change in the sense that maybe the stock market might go down for the next 5 years, whilst the real estate might continue to go up. So nobody really knows, but this is just for analysis. So I thought I would just share this short tutorial in addition to the issues that I addressed in the main video. Thank you so much. I hope you find this interesting.